Hey everyone, Daniel Jones, APR Financial Group. Thanks for joining me. What we're going to talk about today is mutual funds versus exchange traded funds, what they are, the difference between the two, and which is best. Because the reality is, it depends. So let's talk about mutual funds. So mutual funds came on the scene about 1924. And what a mutual fund is a pool of assets. It's just people pulling their money together, and an advisor or a management portfolio group decides they're going to manage that portfolio better than you can individually. So you buy into the mutual fund and they go out and they diversify. So you can actually buy a mutual fund that follows sectors, whether it's technology, healthcare, things like that. So what they do is they take all those assets and they put in one big bucket and they go out and diversify. So if it's technology, they'll go out and buy Apple and they'll go buy Microsoft, right? They'll go buy Dell, whatever that is. And so that's the way they diversify. If it's a mutual fund that follows bond portfolios, does the same thing. Now, the one thing about a mutual fund, the pro, is a diversification. So you don't have to go out and buy all these different companies on your own, buy different stocks to diversify. You go into a pool of assets in this mutual fund and it does it for you. All right. What does that cost? Well, it depends. So there are fee structures, and they're called basis points. That's what they charge you to own that mutual fund, whether that's 0.25%, 0.5%. It's called basis points. It's just a percentage of one. That's all that is. Now, depending on where you have, if you're a do-it-yourselfer, then you'll just pay that underlying cost, 0.1, 0.2, whatever that underlying cost to own the mutual fund. If you have a financial advisor, depending on how that structure's set up, you'll pay the financial advisor and pay the fee for the mutual fund itself, unless the advisor has what's called a wrap fee, meaning no matter the transactions, no matter the mutual funds you buy, you'll pay one fee for the entire portfolio, right? So that's a mutual fund. How you sell a mutual fund. Now, the downside of having a mutual fund is if I try to sell it, and I say it's 2 o'clock in the afternoon and the market's really not doing it great, and I want to get rid of this mutual fund. If I try to sell it, they don't cash out of the mutual fund until the day of, or the end of the day. Meaning, if I want to sell it at 2 o'clock, they won't sell it at 2 o'clock. They got to wait till the end of the trading day to sell that mutual fund for you. You'll get the proceeds. It's called T+2 or T+3, depending on how the mutual fund's set up. Meaning, you'll get those funds within 2 to 3 days, right? So that's kind of a downside of mutual fund. Upside of mutual fund is there are what's called target date funds, and a lot of these are in 401ks and group IRAs, 403bs. And what a target date fund does is it will diversify for you, meaning that if I'm going to retire in 2060, then it's going to go ahead and get really aggressive as I'm young, but as I get older, it's going to get more conservative. So it keeps me from having to keep up with the market and having to continue to diversify on my own, figure how, okay, I don't really know how to do this, so maybe I can just buy this fund so it can diversify for me, right? We've seen clients who've done only target date funds do really well because it does all the investing for them. All right. Downside of mutual funds, one of the downsides of mutual funds also is what's called pass-through income. Now, if you have a 401k or IRA, it's not a problem, meaning the mutual fund doesn't pay taxes. So if they buy Apple 5 years ago, and you bought the mutual fund a year ago, and they decide to sell some of the shares of Apple, it's a long-term capital gain, but the mutual fund doesn't pay that. The owners of the mutual fund pay that. So that's on you at that point, okay? So we've seen clients get phantom income. One of our clients was trying to minimize her taxes. And so what we had to try to do is sell off some of the mutual funds that were having that pass-through income so that she could continue to monitor her income or her taxes. And that mutual fund wasn't helping because of the pass-through income that was coming through and some of the dividends, okay? That's the other thing. Mutual funds pay dividends as well, which is great, right? So that's the basis of the mutual fund. Let's see if I missed anything. There's this gentleman by the name of Peter Lynch. He was with the Magellan Fund through Fidelity. Very successful from 1976 to 1994, I believe it was. And, one of his quotes was, know what you own and why you own it. So understanding how these products work, mutual funds, exchange traded funds, makes sense if this is your portfolio that you're going to be living off of these assets as you retire, okay? So let's talk about an ETF, exchange traded fund. These are fairly new in the market, 25 to 30 years old. And it's the same kind of structure, same kind of basket. You can do technology, you can do all kinds of different diversification, exchange traded funds. The upside of an exchange traded fund is the fees a lot of times are a lot lower. You can trade an exchange traded fund just like a stock. So if I want to get rid of it at 2 o'clock, I can get rid of it at 2 o'clock. I don't have to wait till the end of day for it to clear out. Way more flexible. They still have the same pass-through long-term and short-term capital gains. However, a lot of times mutual or ETFs are managed a lot better with a tax portfolio, so you'll get less of that. What else? Yeah, so which is better? And the answer, it depends. That it really depends. You can diversify in both. You're allowed to invest in different sectors in both: healthcare, technology, energy. Both are professionally managed. Mutual funds are a little more expensive sometimes. You can't trade instantly. ETF, a little less expensive. You can trade instantly. So we're seeing more of the market going towards the exchange traded fund, especially if it's an individual account, not an IRA or 401k, any kind of tax deferred account. It just makes it easier to manage as well. All right. I hope that helps. And this is Daniel Jones, APR Financial Group. I hope you have a wonderful day.